I'm Rahul Singh and I manage the Tata Multi-Asset Allocation Fund. This fund offers a unique mix of equity, commodities, exchange-traded funds, also known as ETFs, exchange-traded commodity derivatives, also known as ETCDs, and debt. The mandate keeps gross equity exposure at 65% or more, with the balance across debt, money market instruments, and permitted commodity instruments. Within this, the fund seeks to actively manage allocations across asset classes depending on how each asset class is placed at that point in time. Over the last few quarters, we have progressively increased net equity in the portfolio. As on 30th June 2026, net equity stands at around 60%, which is one of the higher levels the fund has held in many quarters. Higher equity allocation is a result of lower equity valuations due to price and time correction since middle of 2024. The equity portion continues to have a balanced mix across large caps, mid caps and small caps and remains diversified across sectors and themes. Within equity, we continue to remain overweight on financial services, telecommunication and healthcare, and we are underweight on information technology and consumer sector. During the last 3 months, we have taken selective portfolio actions, including 1 new entry and 1 exit based on our internal assessments. On commodities, we continue to maintain a core allocation to gold, which currently stands at around 12%, up meaningfully from the levels a couple of quarters ago, as we have increased the long positions to take advantage of the recent correction in gold prices. In silver, while our overall allocation is around 7%, it is predominantly arbitrage exposure alongside some long positions given short-term consolidation in prices. The medium to long-term outlook on silver remains constructive on account of industrial demand, especially at lower price levels. On the debt side, the portfolio is positioned defensively with a large majority in sovereign, other debt instruments and some debt instruments with a running maturity of about 5 to 7 years to aim for higher accruals. As far as 2026 is concerned, the year has been volatile with AI-driven disruptions and volatile news flow from the West Asia conflict. Elevated crude oil prices and rupee weakness could weigh on near-term growth and GDP growth may moderate in the current fiscal. Bond markets have factored in some rate hikes and we believe that the RBI could take a more calibrated approach given the growth backdrop. This is exactly the kind of environment where a multi-asset framework could add value. When equities correct, gold and silver could offer a hedge. When commodities consolidate, our equity and debt allocation could contribute. This dynamic mix across asset classes is what we aim to bring to this portfolio. For investors looking for a single vehicle that offers exposure across equity, debt, gold and silver in a dynamically allocated structure, this fund could be a suitable option. You can explore how this fund could fit into your overall investment objectives. Thanks for watching. Stay invested.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.